Welcome to Iron Financial, the place where we forge stronger portfolios by putting market darlings under the microscope. Today, we're cracking open the latest earnings report from asset manager Cohen Steers. Now, on the surface, the numbers look absolutely colossal, like a true titan of the industry. But you know us, we don't just look at the polished exterior. We're here to ask a much tougher question. Is CNS a fortress, built of solid steel to protect your capital? Or is it just a fancy facade, one bad market trimmer away from coming down? Well, we're about to find out. Okay, let's cut right to the chase. The number that's grabbing all the headlines is a massive $93.1 billion in assets under management, or AUM. I mean, that's the total value of all the investments they handle for their clients. A number that huge just screams stability, right? It screams market trust. But here's the real question we're digging into today. Is that number the result of a brilliant, rock-solid business strategy, or is Cohen Steers just getting lucky, standing in the middle of a rising tide that's lifting all ships? Because you and I both know, those tides can go out just as fast as they come in. That's the risk, and that's what we need to figure out. So, to get you the real answers, we're running CNS through our classic four-part stress test. First up, we're going to build the bull case. Is this company's foundation as solid as they claim? Then, we're taking out the sledgehammer. We're going to stress test the financials and look for any cracks. After that, we're going deep into the engine room to look at the AUM flows, the absolute lifeblood of this business. And finally, we'll deliver the iron financial verdict. Let's get to it. All right, let's start by putting on our optimist hat. Let's build the case for the bulls. And honestly, if you just glanced at the top-line numbers from their Q1 report, you'd have every reason to be excited. I mean, they paint this picture of a powerful, incredibly efficient company that's growing, it's profitable, and it seems to be executing its game plan to perfection. So, let's pour the concrete for this argument, starting with the biggest, boldest number of all. And there it is, the cornerstone of the whole thing, $93.1 billion. You have to understand, in the world of asset management, AUM is everything. It's your power source. It's the raw material you use to generate fees, revenue, and ultimately profit. And this number is up almost 3% from just 3 months ago. That isn't just a number, my friends. That's a statement of market dominance. A company this big has pricing power, it has brand recognition, and it has a competitive moat that makes it incredibly tough for the smaller guys to even compete. This right here is the bedrock of the entire bull case. So the next logical question is, how good are they at turning that giant mountain of assets into actual cash? Well, this slide gives us the answer. Revenue for the quarter came in at $145.6 million. Now, that's a really healthy 8.3% jump from this time last year. And, this part is crucial, it beat Wall Street's expectations. The analysts were penciling in about $143 million. Clearing that bar shows that they're not just coasting, they are actively outperforming. Strong top-line growth is one of the first vital signs we look for in a healthy business. It tells you the core operation is humming along just like it should. Now, here's what really gets my attention. It's not just how much money they make, it's how much of it they get to keep. This slide shows their operating margin, and it is a thing of beauty, a robust 34.4%. Let me translate that for you. For every single dollar they bring in the front door, they're keeping over 34 cents as operating profit before things like taxes. That points to some incredible efficiency and really disciplined cost control. And even more important, it's a big jump from the 28% margin they had last quarter. They're not just getting bigger, they're getting more profitable as they grow. That is the sign of a very, very well-oiled machine. And this table, well, this is where it all comes together. This is the awesome power of what we call operating leverage. Just look closely with me. From one quarter to the next, revenue grew just a little bit, 1.3%. But because of that expanding margin we just saw, their operating income absolutely exploded by over 24%. Net income surged right behind it. This is exactly what you want to see as an investor. It means every extra dollar of revenue has this supersized impact on the bottom line. So, on a standard accounting basis, what we call GAAP, this company looks like an absolute freight train of profitability. At this point, the case for this thing being a fortress looks almost made of titanium. Whoa, hold on a minute. A titanium fortress? You know, the most impressive-looking castles are always the ones with the deepest, darkest dungeons that no one ever talks about. That's a really nice story you just told, but it's all based on the pretty, by-the-book accounting numbers. Real investors, smart money, they don't just read the marketing brochure. They look at what's actually left over after all the fancy adjustments. So I think it's time we stop admiring the architecture and we start tapping on the walls to see if anything sounds hollow. And I gotta tell you, I think I found a few spots that sound worryingly thin. Okay, so you celebrated that revenue beat, Fine. But you know what they say? Revenue is vanity, profit is sanity. What really matters is profit, and specifically what we call adjusted earnings per share, or EPS. Now, this is the number that the pros watch like a hawk, because it strips out all the one-time weirdness to give you a much clearer picture of the core business's profitability. And on that metric, CNS didn't just stumble, they flat out missed. The street was looking for 82 cents. They delivered 79. So here's the bottom line. Even though more money is coming in the front door, less of it is actually making it into the shareholder's wallet. That's not a small crack, my friend. That's a problem with the fundamental plumbing of the house. And it actually gets worse. This isn't just about missing some Wall Street target. It's about momentum. The direction of travel is absolutely critical in investing. And this slide shows you that their 79 cents in adjusted EPS this quarter is actually down from the 81 cents they earned in the previous quarter. So while our analyst over here is showing you all these pretty gap charts with big green arrows pointing to the sky, the single most important profitability metric that everyone watches is quietly pointing down. The walls of this so-called fortress aren't getting higher every quarter. On this metric, they're actually getting shorter.
Now, let's go back to that giant, impressive AUM number. The quarterly report loves to boast about $2.7 billion in market appreciation. That's just the market lifting the value of what they already own. Sounds great, right? But a quarter's 90 days long, and these financial reports have a funny way of smoothing over all the bumps in the road. So I did a little digging into their monthly numbers, and I have a very specific question. What on earth happened in March? Because the story of the last 30 days of the quarter tells a completely different and, frankly, a far more alarming story than the one for the whole quarter.
And here it is. This is the skeleton in the closet. Just look at this table. At the end of February, CNS was flying high, sitting on over $98 billion in assets. But then March happened. In one single month, the market wiped out over $5 billion from the value of their funds. That one brutal month didn't just cancel out the gains from January and February, it completely vaporized them. And this right here reveals the company's Achilles heel. Their big, impressive fortress is built right on top of a seismic fault line, and that fault line is the whim of the market. And in March, let me tell you, the ground shook violently. Let's just put a final massive number on it. From the beginning of March to the end of March, their total assets under management fell by $5.3 billion. The quarter didn't end with a strong finish, it ended with an absolute nosedive. This is not a story of resilience, this is a story of extreme vulnerability to the market. It shows that no matter how well run the company might be, its fate is chained to market sentiment. And when that sentiment goes sour, the damage is fast and it is deep. This isn't a fortress that can withstand any storm. It's a beautiful glass house in the middle of a hailstorm. Okay, you make a solid point. A $5 billion hit from the market is significant. There's no question about that. But market volatility is the price of admission in this business. One bad month doesn't automatically condemn a company. The real test of strength, the test of a true fortress, is the underlying business itself, is the engine sound. Let's forget the market noise for a second. We need to analyze Cohen Steers' core strategy, where they actually invest, where their clients are choosing to put new money, and whether that strategy is built to last. And this is what they do. This chart is their identity. Just look at the breakdown. They are specialists through and through in real assets. Nearly half of their entire business is in U.S. real estate. And when you add in their global real estate and their infrastructure holdings, you've got over 3/4 of the company dedicated to tangible things. Buildings, pipelines, cell towers. This is not a firm that's out there chasing crypto fads or meme stocks. They are grounded in a durable, physical asset class. That specialization, that focus, is their strategic anchor in a choppy market. And if you look inside that specialty, you can see a clear engine of growth. Their global listed infrastructure business grew its assets under management by almost 10% in a single quarter. That's a huge green flag. It tells you that investors are actively buying into this part of their strategy. It's where the momentum is right now. Okay, that's a fair point. That one part of the engine is firing on all cylinders. But a car has more than one cylinder, right? What about their second largest business segment? This one right here, preferred securities. It makes up almost 20% of their entire company, and its AUM actually shrank this quarter. So for every new dollar that's flowing into infrastructure, you've got another major part of the business that's leaking oil. You can't just cherry pick the one part that's working and pretend the other part isn't acting like a dead weight on the whole operation. But let's zoom out and look at the overall picture of money movement. The big question is, are clients running for the exits? And the answer is no. This chart shows that for the entire quarter, They brought in almost $4.5 billion in new money. Yes, nearly $4 billion flowed out. That's just normal churn in this business. But the net result, the number that really matters, is that bar on the right. A positive net inflow of $497 million. In a quarter with that kind of crazy volatility in March, having almost $500 million in new capital come in the door is a powerful vote of confidence from their clients. A powerful vote of confidence? Are you serious? Let's put that number into perspective. $497 million of new money on a $93 billion base. That is like trying to patch a giant hole in a dam with a single piece of chewing gum. It's an organic growth rate of about 0.5% for the quarter. It's basically a rounding error. And remember that disastrous March we talked about? The net inflow for that month was a measly $42 million. So when the market ripped a $5 billion hole on the side of their ship, their clients only managed to throw in $42 million worth of new water. Those inflows are nowhere near strong enough to counteract the kind of market damage we saw. It's a leaky bucket, plain and simple.
All right, we've laid out the bull case. We've taken the hammer to the financials, we've inspected the engine room, and we've checked for leaks. It is time to step back, put all the pieces together, and deliver the iron financial verdict. So, is this company a fortress built to protect your capital, or is it a fragile facade, just waiting for the next big storm to hit?
So let's break it down. The foundation is built on some undeniable strengths. You've got that massive $93 billion AUM base, which gives them incredible scale. They beat revenue expectations, and those expanding operating margins prove they're an efficient machine. Plus, they've got a clear growth engine in their global infrastructure business. These are the heavy-duty steel beams holding the structure up.
But the cracks in that foundation are just impossible to ignore. That adjusted EPS miss, the number that really matters, is a big problem, and it's heading in the wrong direction. The entire structure was violently shaken by that $5 billion market hit in March, which proves it is absolutely not shockproof. And the net inflows that are supposed to be reinforcing the walls, they're just a trickle, and a core part of their business is actually shrinking. These aren't just hairline fractures, people. These are signs of potential structural stress.
So here's the final verdict from Iron Financial. Cohen Steers is a company with a very solid identity, and it's built on that tangible bedrock of real assets. Its scale and its profitability are undeniable strengths. That part is a fortress. However, that fortress has a critical flaw. There's a clear crack in its earnings armor, and its fate is highly dependent on what the market does next. So what's the takeaway for you? Well, if you're an investor who believes these market headwinds are just temporary and that the long-term value of real assets is going to win out, then this foundation probably looks strong enough to hold. But if you're an investor who is wary of volatility and sees a declining EPS as a massive red flag, then those cracks look far too dangerous. The key metric you have to watch going forward is a simple one. Can they turn those net inflows from a trickle into a fire hose? Because right now, the structure is carrying a very, very heavy load, and it needs reinforcements that, as of today, just aren't there yet.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.